Well, choppy trade continues across the financial markets, volatility across the board remaining high. Although it must be said that while focus remains on the banking breakdown, there are some tentative signs of issues sorting themselves out and some stability coming in both in the US regional banking sector and here in Europe as well. Amid that backdrop, central banks continue to raise rates, continuing to tighten policy. The FOMC, the Bank of England, the SNB and the Norges Bank all raising rates last week, although it's the dovish repricing coming through after the FOMC meeting that's really started to drive markets across the board. It is a quieter calendar this week, but with month and quarter end on the horizon, I don't think there's going to be any chance for us to put our feet up anytime soon. As always, plenty for us to discuss in the trade-off this week. So without further ado, let's get into the show. So it must be said, things have calmed down a little bit, and I, for one, am quite glad of that, because I think last week was the first weekend in about 3 that we finally did manage to tear ourselves away from our screens and have a little bit of a break. Let's bring in our co-host, Ryan Littlestone from ForexFlow Live and Forex Analytics. Ryan, how are you doing? Refreshed after a weekend for a change?
Yeah, for once. Thank you for giving it the kiss of death and saying we might have a quiet week this week. I expect at least 5 banks to have gone under by the time we finish doing this show.
I did used to have a little bit of a reputation for jinxing things when I made sort of predictions on the markets. So hopefully that does not prove to be the case once more, because I think we will all be very, very glad to put that in the rearview mirror. And certainly policymakers will. And that's what I want to get onto first, or at least at some point in our topical thunder section. So let's get onto that first of all. So I'm not sure what Ryan's looking for down there. Maybe he's trying to find a bank that's gone under. I'm not entirely sure. But some of the banks that haven't gone under are the central banks, thankfully. Otherwise, we would be in a heck of a deeper mess than we are already. As I said in the intro to the show, it was a big, big week of central bank decisions last week. The Fed, the Bank of England, the Swiss National Bank and the Norges Bank over in Norway as well, all delivering their latest policy announcements. And I guess it has to be said that surprises were sort of few and far between, to be honest with you. The Fed raising rates by 25 basis points, as we expected. A little bit of a dovish turn, it must be said, from the FOMC, removing that reference to ongoing increases from their statement. So a little bit of a dovish bias there. Perhaps the opposite coming through from the old lady at Threadneedle Street, just to over Ryan's shoulder there, also raising rates by 25 basis points. But the vote split was more hawkish, 7-2. We were expecting a few more dovish dissenters. And we also had, obviously, the reiteration that the BOE will raise rates further if they see signs of persistent inflation, to which I would say CPI has been above 10% for 6 months in a row. How many more signs of persistent inflation do you really want to see? We also had the Swiss National Bank raising rates by 50 basis points. And if we're talking of jinxes, Ryan, I'll bring you in a second. The Swiss National Bank in their statement saying that the measures they took with regards to Credit Suisse, and I quote here, put a halt to the crisis. Do we think that's going to be famous last words?
They created the crisis in the first place, because no one can understand really what was wrong with Credit Suisse for them to act that way, but they done. Is it the end of the crisis? I think, seriously speaking, if we can survive this week without any further issues happening at banks, then perhaps we are putting the worst of it behind us and we can move on.
Well, fingers crossed, because we all hope that that is going to be the case. I think out of all of those, and of course, we had the Norges Bank raising rates by 25 basis points as well. I guess the most interesting one for me was the Bank of England. I mean, I know we've had a bit of banter going back and forth for some time around whether they're going to get bank rate to 5% or not. But I would actually argue out of all of those meetings that we saw, I think the Fed was pretty much as expected. I think the market reaction now pricing, 80 odd basis points of cuts in the back end of the year is far too aggressive. But actually, the real surprise was the BOE retaining that explicit tightening bias that I thought, and I said on the show last week, they've been looking for any excuse to bring the hiking cycle to an end. The financial stability risks seem to have given them the perfect excuse. And I thought it was interesting they didn't take that.
Yeah, well, the Bank of England, I mean, I expected them to go the 7-2, particularly after that inflation data. It was 6.3 expected. And yeah, I mean, I differ somewhat. I think the Fed was the biggest change there. They really put what the banking crisis effects, if you like, at the forefront of their policy, whereas the ECB made the divergence clear between policy and financial stability. You know, Powell's pretty much put forward the excuse that the economy could suffer because of, you know, tightening credit and that sort of thing. And it's given him, as I say, an excuse. If they don't hike, if they go into pause, any economic weakness, they can blame it on the banks. But regards to the BOE, maybe a bit more hawkish than expected. As you said, we have this discussion on and on. I still think they're going to 5%. You still think it's punchy?
I do indeed. I'm going to say it again. I think 5% is punchy, just so that's on the record once more. Our screen appears to have, I don't know whether AI has taken over, but it's moved on to policy divergence nonetheless. So why don't we get into that? Because I thought it was interesting that amidst all of that, if you look at the best performing currencies on the week, it was the Norwegian kroner and the Swiss franc that actually outperformed last week. And I just wonder whether that is perhaps a little bit of a hint at some of the divergence plays that we can start to take a look at in the FX space.
Yeah, definitely. And, you know, if we look through, you know, a long list of central banks, we've got the BOC on hold. We've got the Bank of England supposedly close to a hold. The RBA may be moving towards a hold. You know, the Fed have gone super data dependent now, as I've just said, and they're blaming the bank situation for further weakness. Like you say, there are others that are still going. The Norges are still going. But out of all the majors, the ECB still look the most hawkish. And, you know, it's quite a surprise to say that. You know, I won't mention pigs and flying. No,
because that one did come back to haunt me, didn't it?
yeah. But, you know, it's strange to have the ECB top of the list of the most hawkish around. But, you know, with the ECB, it's not going to take much for them to dial it down a bit. Lagarde got a little bit of a shot across her bows from her policymakers about, you know, giving too much guidance, forward guidance on rates. But the divergence is showing now, and we're shifting perhaps into that mode where rate hikes are looking to pause. We are getting towards the end of hike cycles, as long as inflation plays ball, of course. And if that happens, then we're going to be looking for, in trading terms, more divergence between the central banks. Which ones are then going to be likely to cut first? Of course, the money's always going to go what the Fed does. But this is where the trading gets interesting, because if the ECB keeps going and the Bank of England stops, there's your trade for euro sterling, and vice versa if the BOE is forced to continue higher. So all these divergence trades are going to be coming in over the next few months. Then I think a couple more months, then we really start towards the end of the year looking at cuts, looking at how economies are doing, and trading the next trend, if you like.
Yeah, exactly that. And I mean, it's quite remarkable how quickly the narrative has moved and how dramatic the repricing has been. I mean, I think it was only, I forget the date, it was either the 7th or the 8th of March when Jay Powell was sat in Congress saying, you know, lobbing a 50 basis point hike back on the table for the March FOMC meeting. And of course, the market reacted accordingly to that. And now you've got a case where actually money markets and Fed fund futures are pricing in 3, if not 4 rate cuts before the tail end of this year. And I think that just does cloud the picture a little bit, because you've got almost 2 divergences at play here. One is the obvious in terms of who is raising rates the quickest and who is getting rates to the highest level. But the other one is, and I appreciate this can be a little bit harder for retail traders in particular to monitor, but the other is the market's expectations of rate cuts and who is or isn't likely to live up to those expectations. Because as I said earlier, I think what the market's got priced in the Fed curve is far too over the top. I think it's far too aggressive in terms of that rate cut pricing. But then when you look at someone like the Bank of England or even the Bank of Canada, where actually the chances of them loosening policy are probably, I would argue, this year higher than that which we see from the Federal Reserve, actually those curves aren't pricing cuts to anywhere near the same degree. So I think it's a really interesting topic that I'm sure we'll dig into many times in the coming weeks and months. But actually, I think there's probably 2 divergences at play rather than just the obvious one.
Yeah, most definitely. We know with the Fed, the trade is there. Market will always go too far. It always goes too far with expectations. It went too far just before this banking stuff with rate expectations and ceilings for the Fed. It'll go the other way. We already saw the pivot trade and what that looks like, a couple of months ago. So we've had a taste of it. And for us trading it, when markets go too extreme with expectations, there's a trading opportunity.
Exactly that. Well, speaking of extreme markets, I guess the banking sector could be described as an extreme market, such as the trade that we've seen over the last 3 or 4 weeks. And actually, the eagle-eyed amongst you will notice that the picture up there, wherever it is, that side, has been changed to Deutsche Bank this week. And that's because I've run out of pictures of other banks to use. The market had a bit of a wobble over Deutsche on Friday. The share price coming lower, the CDS moving higher by around 40 or 50 basis points. But it seems as if things are okay when it comes to Germany's biggest bank, although they have been a bit of a basket case for years. They don't seem to be, touch wood, in the same sort of trouble that Credit Suisse managed to get themselves into. But I think it's important to note that actually what we've seen over the last week or so is a little bit of calm come into this issue. We obviously had the Silicon Valley Bank insolvency. They've now been sold to First Citizens, depositors protected, markets drawn a line under that. Then, of course, Credit Suisse getting that shotgun marriage with UBS. That seems to have settled some nerves. Markets drawn a line under that. Now, of course, we still see volatility elevated across the board. The MOVE index, if you look at various measures of FX volatility from JP Morgan, for instance, and the VIX is still a little bit elevated as well, between sort of 20 and 25. But I think by and large, the market is trying as much as it can to draw an issue under this problem. And I think you said rightly earlier on in the show, if we do see this week, if we manage to get through this week without any other unexpected headlines, any other banks going to the wall, and some of this data that we're getting from the Fed in terms of deposit flows into money market funds out of those smaller banks, and also if we start to see some of the usage of the Fed's liquidity facilities roll over as well. I mean, last week, the Fed balance sheet rose by about 300 billion, which unwound about 5 months worth of QT in one go. This is not QE, by the way, but that's a whole different conversation. But if we start to see the usage of some of those facilities slow, if we start to see measures of financial stress ease, then I think markets are really going to start to run away with this. And I think that could be a catalyst for risks to be propelled quite significantly higher.
Yeah, definitely. And I still don't understand why the market took pot shots at Deutsche Bank. Probably the same reason, maybe some scrupulous players trying to push the buttons of a few banks like they did with Credit Suisse. They got a result there. They haven't so far yet with Deutsche Bank. And I think, there is the protection in play now for banks. We know all the programs that are going on. The EU have built programs. The Fed have built programs. They brought in this new program. So they're always prepared to throw cash at it. So most definitely. I don't think we're at the end of things yet. I still might think there might be a few little skeletons falling out the closet, maybe from these interest rate rises, catching a few more off guard. But I personally think the Deutsche Bank situation could be on its way out. We could be at a near resolution now. And that leads us into my next chart, which is worth talking about.
Well, we'll get on to that in a second. But what I was going to say, just very briefly, before we do move on to that, is I think it's not only the measures that have been put in place that are reassuring markets, but I think it's also the signaling effect that has, where central banks are effectively saying, not that we're going to bail everyone out and everything's going to be fine and dandy, but saying we have the tools to protect our banking sector. We have the tools to provide institutions with the liquidity that they need to get through whatever they're being battered with at any one time. And I think the market is seeking some significant degree of solace from that. Although, of course, then you run into the longer run issue of moral hazard. And I think that could sort of rear its ugly head again at some point in the future once this is all said.
That went out the window years ago, the moral hazard.
Yes, that is very true. We can but dream that it still exists. Back to reality. There you go. That was a nice segue, wasn't it? What about the reality of trading, Ryan?
Yeah, well, this is something I wanted to touch on. And, it's taking a little bit off topic from, talking about the everyday stuff. And it's a subject that comes up a lot in our chat room and our circle. And, you know, I want to talk about traders, their focus on trading, their aspirations for trading, and what you want to achieve from trading. Okay, now one thing I've learned through trading is it's not about trying to hit a home run or a six every trade. It's merely about compounding my account. Now this goes on way back when I started in the 90s. And there's two ways you can build up your account. You can do it on a percentage term, or you can do it on an amount term. So if you want to look at a percentage term, let's say you've got an account of, say, £10,000. So, you know, if you earn, say, 5% a month, you're earning roughly, you know, £500 a month. You build that up over the course of a year. Let's say you earn £500 each month for the course of a year. That's £6,000 you made at the end of the year. Add that to your account. Your account's now £16,000. So it's up 60%. That sort of return you're not going to get anywhere in the market. You know, is ridiculous. But if you carry on doing that, and, you know, over a few years, let's say 2 or 3 years, you just keep doing that 5%. That's all you need to make, 5% a month. You know, 3-4 years, you built your account up to, you know, something like £65,000, and maybe your 5% a month is now in the £2,000 area. You know, that's a good income. Just from slowly compounding your account, building up your trades, building up your profits. Now, we know that relies on you having a 100% success rate to get to those sort of numbers, which we know is not achievable in trading. Not even me doing it this long can achieve that sort of success. But even if you work on a basis that you're going to win maybe just over 50% of your trades, and it's important to remember, you know, you want to make your winners count more than your losses. And even if you run at half that, even if you run more conservative, that you're still going to build your account up over time and get to a level where your income is going to be worth something to you, and maybe you can take it up as a career. Now, the other side of the coin is you can focus on making an amount. Let's say you want to make a target of £500 a month. Okay, that's £25 a day, you know, over the course of 20 days. You know, that's really small pips. You know, you need to make 5, 10, 15 pips a day for a total of £25. Switch off your trading screen, move off, build that up again, and you get to the same basis where you're going to be earning £500 a month, £6,000 a year, and then your account is scaling up as you go along. And the great thing about that is your risk is minimum. You are not risking maybe not even 1%, not even 0.5%, maybe just 0.25% on each trade. So you're keeping your risk low, and you're just looking to make those pips, add those pips up, and that way you compound your account, you know, over the course of 3, 4, 5 years. Then you're trading something, and then you're starting to earn some decent money.
Yeah, I think that's a really good way of looking at it, and I'm glad that you've brought that up, because, you know, a lot of the things that we look at on the show, particularly that I look at, are, you know, more sort of medium and longer term ways of looking at the markets, and actually breaking it down like that. You know, you don't need to necessarily take a view on something over a 3, 6, 9 month horizon, and in fact, in many ways, you would be perhaps a little bit foolish to do so when, you know, if you are looking to slowly but surely build up an account, as a lot of people out there I'm sure will be, you know, it is focusing on the short term and that sort of incremental adjustments and improvement that then builds up and compounds over time, and eventually you will end up with hopefully a very, very successful account.
Yeah, not every trade has to be 100, 200, 300 pips. You don't have to get every high, every low on a trade. As I say, it's just about building up. You know, I should do it on the live floor. Go in, make 2, 3, 4 pips, maybe 200, 300 quid, £400. If I'd had that in an hour's trading, I was out the door, gone, finished. You know, that was my money for the month, because I'm living in the real world. I have to pay my bills, and that was money in those days. But yeah, don't look up here. Don't look for the jackpot wins in every trade. Just look to slowly build up your account. Most importantly, win more than you lose.
Exactly that. Slightly off topic, but you mentioned the live floor, and it did used to be in the building behind you. Did you see that? I managed to dig out a documentary the BBC made on the live floor over the weekend. Did you see that when I said?
No, I didn't. I probably have seen. Is it an old one, or is it?
Yeah, I think it's from mid-90s. It was before they moved to Cannon Bridge House, actually. But I'll ping you the link, because there's probably a few faces that you might recognise in there. Maybe even yourself when you had hair. Who knows?
Yeah. No, I didn't even have hair back then, so no chance.
Good stuff. Well, let's move on to that as a setup and get into some of the charts. Right, I'm going to look at the dollar first of all. This is me being slightly lazy because I haven't really changed this chart too much from where we were last week, but it is worth saying that although the technical side of things hasn't changed especially much, the fundamental side of things obviously has, with the market having such an aggressive reaction, the rates market, to be clear, to the Fed meeting that we saw last week. But as I said, the technical picture hasn't really changed much, and I know Mr. Morrow in Arizona was such a fan of my crayon skills last week that I thought I would reproduce it just for his viewing pleasure again this week. We had a run all the way down to around 102. We closed below the 50-day moving average. We then got below the 103 level, which has been the bottom of the range that we've traded since the start of February. That gave the bears a little bit of hope, but they couldn't extend gains much further below that 102 handle, which we flagged last week. So we're in quite an interesting spot now. The price has recovered a little bit. We've still got this yellow descending trend line in place that's been running things since the start of March. I think if we can get above that and get a closing break north of there, and importantly north of the 50-day moving average once more, then perhaps we'll see a move back into the 104s. And I would argue that the fundamental side of things probably justifies that, given that I think this dovish repricing has gone too far too fast. But from a technical point of view, if we can't break above that level, then you would say that we are likely to revisit that 102 handle again in relatively short order, I would expect. Ryan, how are you looking at things at the minute when it comes to the greenback?
Yeah, pretty much the same way. I think that we are seeing a little bit of recovery today in risk all round. That's leading to a bit of a bid in the dollar as well. It's not all one way, though. The euro's still struggling a bit, and of course the euro makes up a large component of this. So I think you've got to match this up between what the DXY does and what the euro does, because that's seemingly made a break above 107. If it holds that, that's going to keep the pressure on the Dixie, and maybe you're not going to get that break above. But it is finally poised. Where do we go from here? I'm really conflicted on the dollar right now, given what we've had with the Fed, obviously end of month, end of quarter, end of Japanese financial year. Lots of things happening this week. So you said it would be quiet, but I don't think it will be. But I think, you look at the text and you look for your clues. Are you going to get a break back above that trend line? If it does break, is it going to hold it? If that's the way you're trading it, then that's what you've got to look for.
Yeah, exactly that. I think, patience is probably the name of the game here. Wait, see how the market pans out over the early part of this week. And also, I think, again, risk management remains absolutely key. Although the market has simmered down a little bit when it comes to some of the jitters we had with the banking sector. As you rightly said, Ryan, it is month end, quarter end, Japanese financial year end, any other end that you can possibly think of as well, probably this week. So particularly coming into the top of the hour, particularly the 4 o'clock London fixing as well, we are going to see, or the likelihood of seeing some outsized moves is much, much higher. And also importantly, moves that don't necessarily respect the support and resistance levels that we put on the charts, because they are flow based. So of course, bear that in mind as well, and trade accordingly with that information. We mentioned banks. What about banks?
Yeah, well, banks. I'm looking at this one, and maybe I'm a bit late to the party, because we are seeing a bit of a recovery in bank stocks as we do this show. But I'm thinking that if you're looking at trading the fear and what's happening in banks at the moment, I think if we are getting over the fear today or this week, then we're going to see a recovery in bank stocks. That's something I'm looking at potentially to trade. I've already got some stocks in some UK banks that I generally hold. I may be looking to add to those anyway. But if you wanted to have a bit more of a broader brush, then look at some of the ETFs. And there's a couple of ETFs on that chart there. One is the Amundi. It's the Euronext stocks. So that's like 5 or 6 banks, I think, in that, some of the larger banks in that. And then you've got something like the iShares, the BlackRock BNKT ETF, which covers, well, pretty much every US bank there is. So if you're going to get a sector-wide jump in banks there, then putting it through an ETF, trading through an ETF is maybe your best bet. But I think we're at some choice levels here. We may get a couple more wobbles if we see any further lows in these ETFs or even in stocks. I'm going to be looking at that potentially to hoover up and take a bit of a longer term view on bank stocks.
Yeah, I would be with you on this one, actually. I think the risk reward here certainly favours starting to look at nibbling into the financial sector, not just in the US, but certainly in Europe, but also in Asia, actually. I was reading a note from, I think it was Jefferies over the weekend, and they were saying that it's been really interesting how Asian banks haven't actually been anywhere near as impacted by what's going on as we've seen in Europe and also over in the US. So I think that's possibly one worth looking at. And actually, if you think about it, what central banks and fiscal authorities have demonstrated is a very, very significant willingness to step in and support the banks and provide them with what is necessary. And of course, taking a broad view with some of the ETFs doesn't entirely eliminate, but it does minimize the risk rather than taking single stock plays. It does diversify you a little bit across the sector, which is another way of managing your risk and taking advantage of the theme at the same time.
Yeah, exactly that. I mean, you talk about Asia banks. I'm surprised SoftBank hasn't come up in the same light as Credit Suisse and Deutsche. They're the sort of Credit Suisse of the Asian world. If there's something gone wrong over there, they've got a hand in it somewhere. But early days yet.
Yeah, you'll probably find out they're buying Deutsche stock by the dozen or something. God help us. Right, speaking of stocks, I want to look at the S&P 500. Nice and simple here, or simple-ish. I've highlighted this 4,050 level because it's almost been a bit of a magnet, and it's also been very, very sticky and tough for the market to break through. It was some quite solid support for us earlier in the year. We then obviously broke below it at the start of February when the Fed surprised us to the hawkish side. We obviously had that blowout payrolls number, the inflation print as well, and that really put the bears in control of things. And we haven't been able to break back above it since. We obviously had a test last week, but failed, and price came lower relatively quickly. I think there's a couple of things I'd pick out from this chart. Firstly, that the bulls are, from a technical perspective at least, in control of the market. And as you said earlier, Ryan, we are seeing a relatively solid start to the week for riskier assets as well. Obviously recording this on Monday afternoon. We managed to hold on to the 100 and the 200-day moving averages on Friday. And we're also above this white trend line that's been in place since the middle of the month, which is helping that bullish trend. So I think that's really what I'm looking for. Can we get above this 50-day? Do we then test 4,050? If we get above it, then you'd obviously look for the market to hold on to that firstly, but also then move further towards the 4,200 mark. And obviously, if we can't, then you'd be looking to play things from the short side, possibly back down to that trend line and even some of the longer run moving averages below. But the other factor that I just wanted to pick out very briefly from this chart is if you look at some of those candles, I'm not going to become, suddenly go off about candlestick patterns or anything like that. But just look at how long some of the wicks are on those candles. I think that just implies how choppy and volatile and indecisive trade has been over the last sort of fortnight or so. And really, although we're holding that bullish trend, it is just another indicator of why risk management is still so important in this market.
Yeah, absolutely. And funny, just a quick look on the text. Sometimes when you get texts and candles with big wicks, I tend to maybe put my lines across the body of the candle rather than the wicks. Because if you look at some of those levels you've got there, we haven't been able to, have a body above that line. It's all been the wicks above that line, which shows you that the market isn't really ready to push above there. So technically speaking, that's something to look at. But yeah, I think if we do get a pickup this week, or if things are a bit quieter this week, then the S&P is something to look at. I'm currently long today, just because I think we're going to get a bit of a bounce in the US just on all this bank stuff. But definitely I can see scope to get at least maybe up to that 41 handle. Have a look at those highs. I think 42 might be a bit of a stretch given what's happening in central banks. But if it isn't going to go down, there's only one way it can go.
Exactly that. I think it might be a classic sort of no news is good news situation when it comes to the market there. What about your last chart, dollar yen?
Yeah, dollar yen's an interesting one. It's been hammered pretty much since the 138s. You were speaking about that level up there, 138, 137s as a place to short a few weeks ago. We've coming all the way back down. I'm looking for a range play. We've got some really strong levels down in that 128, 127 zone. It was the prior fib. It's where we held up after that big move off the big highs up at the 152s. So I'm perhaps looking for a move back down to maybe 128, 127 to look into longs, because I think that's going to be where, at least in this phase, the fear trade is maybe going to wash out. But also with the year end in Japan, if we're going to start to see flows and it's money repatriating back into Japan, and if it's heavy, then that's going to put pressure on dollar yen and maybe give me those levels. So really for me, it's a range trade. I'm smelling a bit of flows from last week, just times when dollar yen didn't move with yields and just seemed a bit out of kilter with what was going on. You mentioned it earlier, watch the fixes. They're going to be very important. Obviously, the Tokyo fixes, the times in Asia. So look back overnight if you're in the UK or the US, see what happened in Asia around, I think it's around 9:50 or something like that in the Tokyo morning, just to see if something happened there that maybe gives us an indication that there are flows happening. But look to play the range here, maybe longs into 127, 128. I'll be looking at up to that 134, 135 area to potentially get out of those. And then see what happens in the new year. We're back on the Bank of Japan bus. What's happening with the new man Ueda coming in? So lots of things to trade on this one.
Yes, most definitely. I think that's really good advice to pay close attention to the fixings. And of course, Wednesday is the day to watch. That's T+2 out from the end of the month. So that is likely to be when we get the biggest volume come through on a point of view when it comes to flows. I would agree with you. I think this is a range play. I think, you've got to consider the other big driver of the yen, which is treasury yields. And we do seem to be seeing a bit of stability in the market there. Yes, we're seeing incredible levels of vol at the front end of the curve still. But when you look at the longer end of the treasury curve, things are starting to settle down just a little bit more. And I would expect that would contribute to a reduction in vol in dollar yen as well. Although I'm not entirely sure I'd be looking to buy dips here. I think actually we may see, once this is all out of the way, some of those wage settlements have come in significantly higher than we were expecting. So I do just wonder whether Ueda, once he gets his feet under the table, is going to perhaps give us a little bit more of a hawkish surprise and tone than we are betting on at the moment. But of course, only time will tell. With that said and done, let's get on to our respective plays of the day. I don't know what happened there. I sort of accidentally sounded like a local radio DJ for some reason. That was most certainly not deliberate. This is not a radio show, as you can imagine. I want to look at cable, first of all, this week. We've just been stuck in a range between about 117.5 and 124.5 since the middle of the fourth quarter of last year. And when you think about all of the bedlam and chaos that's been going on in the market since then over that period, it's actually quite remarkable that the pound has been so subdued and so quiet. If you just look at last week in particular, I think actually the ingredients and the recipe was there for cable to have pushed higher. We had the dovish Fed meeting on the Wednesday night, and then we had a slightly more hawkish than expected Bank of England, leaving the prospect of further rate hikes on the table on the Thursday lunchtime. And of course, we had that improvement in risk appetite, the S&P 500 gaining for, I think, the third week in four last week. But cable just could not break free and break properly above this kind of 123 level. And you would have hoped and expected, if you were a sterling bull, for us to move a little bit higher than that. So my play of the day this week is to look to get into some shorts here when it comes to cable, leaning against this 123 handle and also the purple trend line that we've had in place that we've now broken and closed below. I think personally, I would be initially at least looking for a move back towards the 50 or the 100-day moving averages. But if we do see the market start to price out some of those rate cuts from the Fed, then we could easily see us move back towards the sort of low 121s or even trade with a high 120 handle. Of course, the big risk to that is if we do see a significant improvement in risk appetite and the pound remembers that it's meant to be a high beta currency, then we may see us move higher. And of course, if we do get above 123, I'd be looking to take that risk off relatively quickly. Ryan, Aussie yen.
Yeah, Aussie yen. I just want to say quickly on your cable, I'm glad you think that 700 odd pips is fairly quiet for a market. don't have a look at euro sterling. You'll be very, very disappointed.
It's like watching paint dry euro sterling sometimes.
But yeah, Aussie yen is one I'm looking at the moment. Purely on a levels tech trade, we've got a bit of support down here into the 87s. Got a couple of lines here. We've got the 86 number, the big figure, which has been a former resistance area that we've broken and we've held not too long ago. Now we've got this minor line which has been support around about 87.30. I'm looking to see if we get a hold above there to signs that it's going to become decent support to then maybe get into a long, looking for a move up towards the 90s. If we don't hold this 87.30 area, then conversely, look for a move back to that prior low down at the 86. That's the level really that's a line in the sand. Look for longs on there again for a run back higher towards 90s. But if it doesn't hold there, then you've got a chance to flip it to a short on a break there. Maybe to target that fib, that 38.2 fib down at the 83, 87 level. So a quick play on this one. Just trade the levels, as we like to say. You got choice for going both ways, longs here and flipping to a short.
Good stuff. Thank you, mate. Well, that brings us to the end of another show. Thank you, as always, for watching. If you've enjoyed the show, please do drop a like and also leave a comment. Let us know how you're trading the markets as well. And also, if there's anything that you'd like us to discuss and dig into next week. Ryan from Ryan Littlestone, Forex Flow Live and Forex Analytics, thank you, as always, for joining me. Thank you also to the world's happiest producer, Kyriakos, for pulling this together so brilliantly, as he always does. All three of us will be back again this time next week, and we will see you then. Thanks for watching, and goodbye for now.